Trey Parker, I want to bring you into the conversation. After hearing from President Mario Draghi of the ECB yesterday, what's the base case for you guys now on the recalibration of policy later this year, if it does indeed get announced?
You know, I think Mario is still trying to walk a tightrope, as Eric, I believe, mentioned, in terms of waiting and seeing the data. I don't think he's too concerned right now about the euro strength, because on a trade-weighted basis, the euro is only up about 6% so far this year, and I think that they can handle that given the growth outlook that they're seeing across the eurozone. So we still think that both the Fed and the ECB are still in a wait-and-see mode as it relates to policy actions later this year, understanding that they both want to have more ammunition as we get later in the credit cycle.
Well, Trey, is this going to be a move from 60 to 40 for, say, 6 months? Is it a move from 60 to 20 for, say, 9 months? The base case in terms of what they will announce, where are we?
You know, I think they're going to start moderate. I think this is too big of an experiment to go aggressive with the reduction of the tapering. And so just like the Fed, I think that they're going to guide to some moderation initially, see how that goes and how well that's absorbed in the markets relative to the rates, and then potentially increase it later in 2018.
Trey, it's something that doesn't come up much at the ECB news conference, should it? Financial conditions and actually how frothy European credit looks.
Look, I think the ECB's sole mandate is price stability. I think that obviously from a U.S. perspective, the Fed is also thinking about asset bubbles and relative excesses in the system. And one of the things that growth provides and low rates provide is an ability to create those potential excesses. So we certainly have to worry about the low rate environment creating excess demand or false demand and elevation in asset prices. And that's something that I think we need to be thinking about as investors in the marketplace, even though the ECB may not be talking about it.
Because a Bloomberg subscriber has written in with the following question, and Trey Parker, I want to throw it at you. Your take on Treasury yields around 2%, with GDP growth around 2.5%.
Yeah, it's really tough to reconcile the two, right? You've got inflation to 1.7%, obviously below what the Fed's ultimate target is. You've got GDP growth of 2.5%. Something's wrong, and I think the bond market is mispricing growth. So we have a different view from Robert. We think that there's an under expectation of growth, and a lot of the technical dynamics of the Fed continuing to buy treasuries, and so much foreign flows continue to look for relative spreads or relative yields elsewhere in the world is perverting the market. I think the other thing that's amplifying that is just a general tail concern of some of the geopolitical issues that are out there today, whether it's Harvey, Irma, or Korea. I think those are all things that are weighing on investors' heads. And so you see equity markets at all-time highs or near all-time highs, yet bond yields are at 2%. We definitely think technicals are a key factor behind that.
Well, Trey, let's get stuck into it a little bit more, because the burden of proof so far has been on the high yield crowd throughout 2017. PGIM has been dead right. Going forward, if we had the capitulation yet from all of the Treasury bears that were out there at the beginning of the year, is 2% the bite point, or is there more to come?
Yeah, we think 2% is about as far as it's going to go. We think yields are biased to the upside from here, and that's sort of our view.
Trey, when are we going to get a clean read on the U.S. economy, considering the events of the last couple of weeks, the natural disasters that are taking place, etc.? Is it going to be a couple of months for this one to come through?
Yeah, I think there's definitely going to be a few months of pause here in economic activity. Obviously, a lot of it depends on the extent of which Irma hits Florida, but certainly Harvey in and of itself, I think, is going to cause some noise in the numbers. We already saw it in the employment data earlier this week, and we think that overall there's going to be a 2 to 3 month lag in economic activity, which should catch up from the economic data.